Hmm. Michael, baseball opening day. Any baseball fandom?
For me,
Yeah.
not I grew up a Red Sox fan, so that's kind of where my
Yeah.
allegiance lies, being from Boston.
Okay. All right. We're gonna let you go now, Michael. It
All
was nice having you on the show. I'm kidding.
right.
Well, Rich, you didn't ask me.
What? You're Giants, right?
Well, I'm literally probably, even though my background is my background, I'm probably 500 yards from Padre
Oh,
Stadium.
oh yeah, Petco. You're right by Petco.
Yeah, and opening day this afternoon.
Opening day. Yeah, the tribe's opening day starter got physically ill right before his start day. They had to scrap him. That's a bad sign going into the start of the season. When your opening day starter, you got to pull him with a stomach virus a few hours before the game.
Maybe he drank some of the local water.
He drank out of Lake Erie, or no, Vivek wants to rename it Lake Ohio. So we're gonna don't drink out of Lake Ohio. I've got the battle scars from that myself. So, but all right, we'll give everybody another minute or so to get logged on, and then we will go ahead and get started. Rob, you're at MCT in San Diego, obviously, and right near Petco. And you said
And
attendance.
Michael, you're in Manhattan right now.
Actually, I'm in our San Francisco office today, so same
Oh,
coast as
oh,
you. Yeah.
Okay, cool. Yeah, Pac Bell, my favorite. I think I've been to 18 of the 30 MLB stadiums, and I love the Giants Stadium is incredible. That is my favorite. Not counting Cleveland, of course, but of the ones I've been to. So, Rob, you have a favorite MLB stadium you've been to?
I don't have a favorite. I do have a story of when I was taking the Robbie and Marie, my kids, on a tour of all the states. We picked a time coincidentally where the White Sox and the Cubs were in town
Hmm.
playing home games. So we went to both stadiums, and Father of the Year award. I dropped the kids off at at the Cubs
Okay.
to watch the Cubs, and I had to go park the car. And I think they were probably 11 and 9 at the time. And I get to the seats, half hour later, and there's no Robbie and Marie Chrisman at the
Oh, boy.
seats.
Wow.
And I'm like, oh my gosh. And right then on the on the loudspeaker, uh, will the father of Robbie and Marie Chrisman please, you know, go to a white, courtesy phone. And so I tracked them down in the security office. They're
Oh,
sitting
wow.
on the desk eating some candy. And I'm like, and all the guards are looking at me like, what are you thinking? Dropping them off, not the curb. Anyway,
That's
Oh,
funny.
too
anyway.
funny. So, all right, let's go ahead and get into it. This is the big picture. I'm Rich Swerbinsky with Onward and Upward Consulting, joined as always by my esteemed colleague and co-host Rob Chrisman today, taking a break from the MCT conference in San Diego, right outside Petco Park on MLB opening day. So, Rob, good to see you.
I see you.
All right. And our special guest this week, very, very pleased to be joined this week by the CEO of Figure, Michael Tannenbaum. Michael, good to see you, and thanks for coming on the show.
Thanks for having me.
All right. It should be noted, the big picture presented by our friends and sponsors at Depth. 20 years of brand management, strategic communication, public relations, the mortgage and fintech spaces. They are the best in the biz. Depthpr.com if you want to check out our friends at Depth. So there we have it. Well, Rob, the news cycle is not slowing down. It's fast and furious. And what's on the menu this week? We've got Bill Pulte starting to wreak havoc through the GSE, special purpose credit programs under the guillotine. We've got the shocking rebranding of CoreLogic to what sounds like a female hygiene product, Cotality. So still trying to figure that one out. And of course, we've got the mortgage madness, strongest brand competition that's raging hard right now. Figure faring very well in a battle right now, given UWM, I think more than they were ready for in
Right.
round year.
It's
So,
really a David and Goliath story. So I appreciate all the support.
and then of course it's opening day, Rob. So as always, I throw a bunch of gobbledygook at you and see which way you take the show to get us started.
You know, I would say that, so I send this daily commentary out, and to the extent that I can, I try to put news in perspective. Like one day I'll have a bunch of conventional conforming news, another day FHA, VA news, and so forth. And so I try to do what I can to provide some perspective and some semblance of, here's what's going on in this sector. A company like Depth, I assume, can take a client and, figure out a strategy, figure out public relations, marketing, advertising, figure out a package, take their time to do it. The news that's been coming out this week, alone, I mean, just since January 20th, for example, we're once again back to what, waking up in the morning, wondering what was tweeted out or X'd out or whatever you call it, what was put out, and reacting to it. And so Bill Pulte making these announcements using the Elon Musk platform, no surprise. And frankly, uh, you know, after the election, I was receiving a certain kind of emails like, okay, the people have spoken, so forth. I'm not going to go too far down the political path here, but people have spoken. And now those same folks are like, well, we didn't quite vote for this, or we didn't know what we were getting into when it impacts them and their company's product lines directly. And I write back and I say, yeah, you did. You knew what you were going to get, whether it's the news cycle of, 24-hour news cycle or some of these cutbacks. And I saw just RFK today saying he's going to cut 10,000 people from the Department of Health. And so the cuts continue. And I think what they're doing is quite the blitzkrieg of things that are going on out there. And the mortgage community isn't immune from that. So the thinking is that the move toward privatization for Fannie Mae and Freddie Mac, said, people who were talking about, oh, it'll take 2, 3, 4, 6 years. Now they're talking, condensing that time frame and trying to figure out how much capital these agencies need to become private companies, and thinking, okay, if it's going to take double the capital that they have now, where are they going to get it? Because their primary source of income right now is G fee income. And so are they going to worsen G fees in order to boost up their income? Or will they be cutting not unprofitable or marginal programs, and focusing more on more profitable programs, and where does high balance fit into that? Where do some of the affordable housing initiatives fit into that, DEI and so forth? And so second homes. So it'll be a non-owner. So it'll be interesting. I don't think we're done tweaking GSE news or FHA news, VA news, and so forth, and not just from a personnel perspective, but also from a product perspective. And companies are really having to keep their knees bent and pay attention to not being one-trick pony lenders in terms of when it comes to agency type production or government type production, because you don't know what's going to happen in the middle of the night. So it's the fun never ends, right?
You got to get on that figure bandwagon, right? And work HELOC into your
Exactly.
great segue.
Yes, it's a people. Yeah, I agree. I agree, Michael. You're doing it right.
Yeah, well, I think from my point of view, on the agency space and broadly figure, one of the things that we've tried to do is bring the same liquidity and standardization that the agencies have in the conventional space into our market, right? Which is HELOC. And, one of the things we're seeing is because of that standardization, which actually, we've got 140 different people that are originating figure HELOCs all the same way, same standard, all on blockchain, so super efficient. And in doing so, what we get is a much more liquid capital market, kind of akin to the agency space, where you have securitization, secondary sales, people selling amongst each other, and it's all uniform. And I think as a result, we've actually seen this HELOC be used as a first lien, right? So almost 20% of what we do today is actually first lien HELOC. And that's because that efficiency is kind of driving, people to do this versus a cash out. And we also see people doing it in the piggyback world on top of a conventional because, it has that same liquidity and, good pricing. So I definitely feel like, in the past really 10 or so years, it's been kind of hard to understand exactly where the agencies were going. What is their goal? I think it sort of morphed into more affordable, and maybe they're pulling back on that. But it's definitely allowed an opportunity for someone like Figure to innovate at the edge of the agency space and provide, the agencies do a lot of good, and they've unleashed a lot of entrepreneurial activity, right? There's all these non-bank mortgage companies that have kind of emerged on the backs of the agencies. And so they do serve a purpose in the market, but I think there's room for innovation around the edges of where they touch. And that's a big part of Figure and its value proposition.
Yeah, I would agree 100%. The interesting thing is that there's a lot of interesting things in this business, right? But as Fannie Mae and Freddie Mac have either changed their pricing or done this or done that or tweaked this or, with this program or that program, certainly that'll continue. And so in the non-QM world or non-agency world, those investors are saying, okay, is this something we want to take a look at? And what kind of reps and warrants do we need to have? How can we take advantage of 8 changes in the government programs and the Fannie Mae and Freddie Mac programs to allow us to step in there and possibly add to our volume? But I like the way that you have standardized that, because standardization, if you talk about DUNLP, for example, or some of the policies and procedures of Fannie Mae and Freddie Mac, they have helped standardize things in that market, which I think are very important. I remember, though, like you go back to subprime days, you don't know, like, oh, somebody was rolling out an A- program. Well, what does that mean? Or a B+ program or a C pro? What exactly does that mean? Now, even now in the non-QM world, I mean, it seems like companies don't even know quite, is it non-QM with a capital N? Or all, or no, small n, large n,
Right.
all caps. I mean, they can't even agree on what the name actually should be. And so I think standardization, I think lenders like having a certain amount of standardization. And so once again, I think Figure's doing a good job of that.
Yeah, thank you. Sorry, Rich.
Oh, no, I was just going to say, Michael, you figure you guys were, Michael, so early to bet big on HELOC. What gave you the conviction to scale that product when, a lot of other lenders were afraid of it, moving away from it? Yeah, take us back a little bit to the kind of the mindset that brought you here.
Sure. And I never like to take credit for things that I didn't do. So, I joined Figure about a year ago. I was a early stage investor in the company, and I've known Mike, the founder, for a long time. So, I'm aware of the story, but I actually joined about a year ago. But what's interesting is I did work with Mike, who's the founder, one of the founders at SoFi. And what we saw there at the time was SoFi kind of pioneered this personal loan to the mass affluent, right? People that were taking larger balance, call it 50,000 plus personal loans. And most of those people were homeowners. And so, well, why were they doing that versus a HELOC? That's because the HELOC at the time, was a legacy bank product. It basically, was 45 to 90 days to originate. It was for rainy days, right? Rather than, this new kind of fully drawn world that we've moved to. So because of that, that insight was, well, these people would certainly be better off taking a HELOC from a rate perspective. The reason they're not doing it is because of speed. And so what Figure did is they turned a 90 day process into a 5-day process, right? The average time in the funnel for HELOC today for Figure is 9 days. Like, that's the actual average, right? So some is going as fast as 5. And remember that there's a rescission period of 3 to 4 days. So it's definitely a fast moving product. And I think it's that speed that really unlocked the HELOC world back in 1819 when Figure came out with it. And then it's just gotten better. And I think you've also had a rate environment that's helped. And you've also, frankly, because so much of what we do is on the partner end, you also have a world where, frankly, mortgage companies are looking for growth, right? They're looking for things to do, and you have 35 trillion of home equity outstanding. So it is a big opportunity. And we're thrilled to, support our partners in that opportunity.
Awesome. And Michael, and Rob, I think what we're seeing with the GSEs right now, it's really what Calabria told us was going to happen. I think that he said that, the first things to go would be using the GSEs as like social policy vehicles. I think you saw some of that yesterday. But the other thing he said, I remember distinctly, was that if you eliminate the riskiest like 5% of the GSE credit box, the fears and the argument around rate shock when, the GSEs are taken out of conservatorship would be mitigated greatly. So I wonder if that's the next move. And I bring it up on this call because, I mean, Michael, you got to be secretly hoping, right? Like cash out refis get crimped down on.
Well, I think that we exist, as I mentioned, kind of at the edge of the agency, right? Where they stop, we want to start. I think it's hard, at least today, them being the government, it's not wise. I mean, the agency market works well, right? For people that are selling to the agencies. And that's an area where at Figure, we don't seek to innovate on conventional mortgage because we don't think we need to bring standardization. People are happy with DU, right there. But where you start to get value and where I see a lot of opportunity is actually in the smaller balance space, right? You see people, there's 40% of homeowners on their home free and clear, which means there's quite a number of people who have under $100,000 balance mortgages, right? And one of the things that Figure has done is, well, we don't require appraisals, right? Whereas DU sometimes gives an appraisal waiver, right? And we don't require title. We do our own we do our own work. We obviously investigate the provenance of the home and the liens. But what that means is meaningful and material borrower savings. And those start to really add up, on a $60,000 loan. If you're talking about an appraisal and title insurance, you can be north of 5 points just there, right?
Yep.
And so if someone wants to refi that loan, remember, if you're in a $60,000 loan and you want to refi that, it's meaningful to you. That's your loan. But if you're at a mortgage company, they want to do $300,000, $400,000, $500,000, $600,000 loans, right? And so this area doesn't have the same level of attention. And I think that's where we can kind of be a counterpoint to the agencies, for example, on cash out refi, where this world is not necessarily getting the same attention. These borrowers aren't getting that attention. And, frankly, the government and the agency should want that, right? They should want Figure there to be a faster, more automated option for these lower balances where fees actually matter a ton to the consumer. On $1 million loan, sure, what's an appraisal, right? But
Michael, what's your view on just the regulatory environment around like HELOCs and second liens? Any friction or policy tailwinds that you see developing, or on the flip side, potential regulatory relief that could help prospective HELOC borrowers?
it's interesting because I think a lot of people in the broader fintech space, which is more my background, are viewing the next 4 years of the Trump administration as one where regulation is going down. Or trending towards deregulation, I should say. And I think that is broadly true if you kind of just look at what's happening. However, mortgage, as we know, is state regulated for the most part, right? And there's not this huge advantage. Banks don't have an exemption from the licensing regime in mortgage in the same way they do, for example, in lending, right? This concept of like one bank exporting its interest rate and usury rules nationally versus having to comply with interest rate caps and usury caps state by state is very true in the non-mortgage world. But in the mortgage world, that's not how it works, right? You can't just be a bank originator and then all of a sudden charge as many points as you want and ignore state licensing requirements. And as a result, I think that you don't see as much regulatory change because you still have the states there and they're not changing their posture necessarily. So of course there's a tone at the top that permeates throughout the whole industry. And there are certain things that have been more the purview of, say, the CFPB, where there may be less aggressive regulatory actions taken. But I think more broadly, at least the way we're planning our business is no change, right? Same states, same regulatory regime, and continuing to make that an important part of what we do. But I'd be interested in Rob's perspective as well.
Yeah, I think that I don't know if the analogy is quite fitting, but I'll say it anyway. So when the CFPB was invented, was created out of Dodd-Frank, and brokers would send me emails or ask me questions in advance. Oh, is the CFPB? We just have us brokers have a big target on our backs. I bet the CFPB wants to do away with us. And I would tell them, you know what? I don't think the CFPB. I don't think you're on the CFPB's radar screen. They have bigger fish to fry than than going after Rich and Michael's broker shop in Yuma, Arizona. So sure enough, the broker model has flourished, and the CFPB is not targeted brokers necessarily. So I wouldn't say that the HELOC world escapes a lot of oversight, but I will say that it's not a big target. It's especially if you have companies out there, and I'm not going to go through the companies that I believe are in that business or compete with you, but I would say that from what I know, those companies are minding their P's and Q's and are doing things in a compliant, sustainable manner. And I would imagine doing their best to keep their consumer complaints down. And in fact, you're greatly helping the consumer. And so therefore you kind of escape a lot of scrutiny from Washington, D.C., regulators, and so on. One would hope.
Yeah, I think, we're still held to the same standards, but in general, it always helps to be on the right side of the borrower long term. And I think
Absolutely.
we're giving borrowers a low fee, quick access, lower rates than personal loans, lower rates than credit cards. In fact, we see, almost 20% of our customers will use our product to pay off directly debt, right? And lower their monthly payments. We've seen credit scores post-figure HELOCs go up, sometimes as high as 40 points, on average as high as 20, right? And so these, we are definitely, these are loans that are helpful to borrowers. We also, of course, do a lot of home improvement as well. So I do think, from my experience being in the space, fintech more broadly, being in a product that is helping people lower rates on average, lower obligations, is going to be viewed more favorably than certainly the opposite, right? So we do have that advantage going for us, but that doesn't negate our need to comply with all the rules.
Michael, your business model, fascinating. And it's also fascinating in that you're business to business, mortgage lending institutions are clients of yours. You're also direct to consumer. So just curious, like, what's the mix? What's just your view on those two channels and like the growth and go-to-market strategy, 25 and beyond in those regards?
Yeah, so almost 80% of what we do today is B2B. And I think that's been the fastest growing part of our business. What I kind of think about it as this world of what you might have heard the term embedded finance, but Klarna and Affirm are examples of that in a different space where you have what companies that are great at customer acquisition, like a Peloton or Walmart or whoever, but may not be necessarily great at financing. At the point of sale, someone like a Klarna or an Affirm will integrate there and unlock in a buy now, pay later additional funds and purchasing power, just like layaway used to do, right? And I think Figure is similar in that we are embedding inside banks, mortgage companies, fintech, home improvement, solar, and saying, look, we can facilitate a HELOC for you much faster and better and more standardized with a deeper capital market. And you don't have to worry about any of that, right? You just keep acquiring customers, doing what you do, and we'll take care of that. And so it's just this specialization that allows us to embed inside of other people's funnels and businesses, which I think is helpful, especially because HELOC is moving from a niche product to a mainstream product. And so, you wouldn't necessarily, even today, right, there's not a lot of HELOC only mortgage companies, right? It's typically that HELOC is one of the strategies that people are pursuing. And as a result, because it's a non-agency product, kind of bringing it full circle, there's an opportunity to standardize and bring sort of the same way that, people that are doing HELOCs, they don't have the option to sell those to the agencies, right? There was a closed-end second sort of pilot from Freddie. I'm not sure the status of that, but regardless, it was very limited and not really competitive with what we do. So I sort of see it from that standpoint. And you see that the reason I bring up Klarna and Affirm is those are obviously, growing and thriving for some of the same reasons that Figure is, even though we serve a different customer. On the DTC side, though, that is important to us because, as we all know, a lot of times DTC is the best place to innovate and test, right? You're going to get the fastest feedback loop. And a lot of partners don't want to be the guinea pig for new products. They say, we'll work on your new product, or we'll offer that once we know other people are, right? And then so you get this chicken and egg issue. Whereas for us, if we can kind of do it ourselves, work out the kinks, show that people want it, people are much more likely to adopt. So I think that's one of the reasons. And another is just like, back to the regulatory point, you do get into this world where you need to be licensed to offer a mortgage, but many of the people that we work with, especially in the home improvement solar space, they're not licensed, right? So we need to be the licensed originator. It needs to be an MLO on our side because there's going to be partners that just don't. And so DTC is sort of a logical extension of that because we have to have all that infrastructure regardless. And so that's kind of how we think about the world.
This is the big picture presented by our friends and sponsors at Depth, depthpr.com, the best in the biz when it comes to representing your company, brand management, strategic communication, and public relations. And Michael, you mentioned at the outset of the show that I think you said almost 20% of your production right now was first liens.
Yeah.
So if you could talk a little bit about product, how that's evolved at Figure, and maybe how it could continue to evolve in the years to come.
Sure. So, building off the HELOC, couple things that we added recently, I talked a little bit about the ability to pay off debts, right? And so relatively recently, within the last 9 months or so, we launched the ability to use Figure and pay off things like personal loans, auto loans, credit card, which not only help from a qualification DTI perspective, but also just help people, as I mentioned, kind of improve credit score, improve their borrower profile, improve their rate. So that's been a really big thing that we've launched. And we are very shortly launching the ability to actually pay off other first lien mortgages. And so what that does, kind of circling back to the comments we were making about fees and rates and smaller balance, it allows the Figure HELOC to be used as an alternative to a cash out refi, especially in the smaller balance space where today, the agency process is $12,000 to originate a loan, right? After you're done with all the fees, all the time, all the work, title insurance. So you're talking, that's the average. And
Compensation.
what'd you say?
Compensation.
Totally. Right. And so you're at $12,000, but your loan amount, say someone has a $60,000 arm they want to pay off because the interest only period is over, the fixed period is only over, whatever, right? Mainly the fixed period's over, or they have a non-QM loan that they took out and they want to take a bit more cash out, take a 60,000 up to 90,000, right? So at a $90,000 loan, $12,000 is north of 12 points, right? So like that starts to be untenable. Whereas Figure, we're going to do that. We can pay off the first, and we can do that as a HELOC. And because our process is so streamlined, that'll cost us about $1,000, so 1/12 of the cost. And you're talking about 1 point, right? And that's materially different, and that allows us to be very, very competitive in that huge space of people that either own their home free and clear or have these small first liens that they want to pay off.
Michael, how has just investor demand for your product been in the secondary market? I'm fascinated to hear that. And as a kind of part two to the question, just a lot of the depositories that are clients of mine, you know, still some of them a little squirrely about maybe HELOCs to 80%. Just we've seen
Right.
42% run up in home values these last 4 years. If you get a correction that is historically accurate, those 80%ers could be 95ers in theory in a few years. So investor appetite and just your thoughts on that component to it.
Look, I think from a risk perspective, Figure is operating with largely 65-ish LTV post loan. So there's a lot of equity out there, as I mentioned, 35 trillion. So there's definitely a lot of cushion. But I do think we are benefiting and also just participating in this broader trend that you see of non-bank origination and non-bank credit or private credit, right? There's just been this explosion of private credit. Generally, it's been in the commercial space. So it's been, commercial loans, CLOs, commercial real estate, that kind of world has all shifted off bank balance sheet. But as there's just an insatiable demand for yield coming from largely, private equity owned insurance buyers, those types of people, as that's emerged, consumer is this huge asset class, and as a result, people are looking for the consumer origination as well. And so for us, we see largely non-bank buyers of our loans, mostly in securitized form, right? So most of what we do is either through Figure Connect, which is interesting, right? Our partners actually are the ones who own and originate the asset, and they contribute into our securitization or sell to buyers through our BWIC and OWIC functionality. So we actually give the ownership of the loan and the economics of that ownership to our origination partners, and then they contribute into our capital markets or our securitization shelf that we maintain. So it's almost like similar to Fannie Mae, right? We set the standards, we set the boundaries, we build the market, but people have kind of direct access, just like the cash window.
And Michael, the early days of Figure, I remember because they joined the Mortgage Collaborative as a lender. It was really based around blockchain lending initially.
Yeah.
You mentioned blockchain earlier in the show that
Yeah.
HELOCs are closed on the blockchain. So if you could talk a little bit about that. I mean, it seems like for a decade plus we've been talking in the mortgage industry about blockchain, the general thinking. I mean, the technology works incredibly well for the real estate finance industry.
Right.
Yet we haven't seen really any kind of mainstream adoption out of it. You guys would be the biggest use case.
Right.
Your thoughts broadly on blockchain, Figure's evolution with the technology, and what mortgage lenders listening to this show should know as it relates to this emerging tech?
Yeah, I think one of the interesting things about Figure is we actually don't require people to know that much. If you go back to cloud as an example, which is another technology that, say emerged 2010, 2011, before that, there wasn't cloud software, software was hosted on premise as an example, right? As software started to emerge, of course there were people who were really excited by cloud, but lots of companies just built software and it worked better because it was on in the cloud, right? And I think we're trying to be one of those people for blockchain. We're saying, look, we're going to give you standardization, we're going to give you low cost, we're going to give you efficiency, we're going to give you liquidity. Those are results of our blockchain, but we're not asking you to care about it, right? Because most people don't. And that's okay. There's going to be some people that are really into it. And we actually absolutely do get some, especially mortgage, IMB CEOs that are excited by blockchain, are excited about participating in the future of finance, and that brings them in and makes them want to work with Figure. But most people are just saying, give me the answer, right? I don't care how the sausage is made. And so what we're really doing, I think a couple simple examples of where we add value with blockchain. One is around our process for income, right? So we don't do any underwriting of income. We have a model that assesses income, and there's no underwriter involved. And as that income is verified, it's hashed in the blockchain day one. and then it's validated then. And then as the loan moves throughout the capital markets, warehouse, securitization, owner, buyer, people don't need to re-verify that. Like we see 70% lower third party or TPR review costs because people understand that process and that standardization up front. And we're not checking, did Rich and Rob, underwriters, did they do the right thing? Do we think that they understand the collateral? Like we don't need, because it's all model based and it's all hashed day one. That's one good example. I think ownership is another where we have a competitive product to MERS, right? And basically what our product does, it's called DART. It listens to the capital markets activity of the loan. And as the loan is transferred within the blockchain, it knows and it updates the record and the ownership automatically. So you don't have to do anything versus, logging into MERS and changing the ownership and verifying that with the person and checking the collateral docs. So it's a much faster and simpler and more automated way. And those, I think, are two examples of like the tangible benefits you get from blockchain, but you don't need to do anything like crypto to benefit from that, which I think is actually why Figure's been successful, because we haven't forced people to necessarily interact with it or care. But of course, there's going to be some people who do.
In the first mortgage side of the business, Michael, blockchain, do you envision a near future where the blockchain and blockchain tech is more immersed in the first mortgage process? Or are there too many headwinds to that still?
No, I mean, we already originate first mortgages, right? They're as HELOCs, but so it's not that anything about the first lien space is preventing. I do think, going back to the agencies, which we've talked about a bunch, right? They require MERS, they
Yeah.
require tri-merge, right? There's a lot of, I don't want to say monopolistic, but there's a lot of aspects of the agency process that make it difficult for someone like Figure to innovate and change the way things are done. I think even if you look at the transaction settlement times in the agency space, or what some people refer to as the drop, right? Like how long it takes for the loans to start actually paying cash flows to investors is really, really long. And if things were being settled instantly or close to real time on blockchain, that would be different, right? But I do think right now the agency space is kind of working the way people wanted to. And so there's not as much innovation, which is why we sort of try to innovate outside of that space, because, they do require MERS, and there's a lot of, monopolistic, or I guess they sort of pick winners vendor wise. And if you're not one of them, it's hard to break through, which I'm sure, other people can relate to that for sure.
Yeah, FICO, MERS. I mean, blockchain almost stands to make MERS not needed, right? If
Right,
I'm
exactly.
right.
Yeah, absolutely. That's
So,
kind of what we offer, as a faster, cheaper blockchain MERS. But, if you're selling to the agencies and say the loan has to be on MERS, there's not much you can do.
right, exactly. So,
So Rich, I'm going to turn the tables here a little bit. I mean, you have clients who you could point towards blockchain, or
mhm.
maybe you do, because earlier, like to start this discussion, you were talking about how incredibly successful or competent, or whatever term you used regarding blockchain. Have you tried to do that? And what do you, if so, what are you hearing? What do your clients say about it?
Well, I mean, like Michael said, I mean, the roadblock right now is just the GSEs, and I think that, my depository clients, they're putting some loans in the portfolio right now, but I think that's why like Figure's got an incredible opportunity with depositories, because, their balance sheets it's just tough for depositories to put mortgage loans in the books right now because of interest rate risk reasons, liquidity risk reasons. So even, maybe some of those that the current regulatory environment makes it very difficult for depository institutions to portfolio a lot. But banks can portfolio. Like, it's easier said than done. You gotta hold capital against it that you can't do anything else with. There's all sorts of regulatory hoops. So, I just think it's not viable right now because, all secondary market loans have to have MERS, and thus, the blockchain would not. Am I right in what I'm saying there, Michael?
Yeah, I think that's right. I think that that's why we're building kind of our own marketplace that is standardized on the blockchain and kind of adding assets, adding participants. And ultimately, we think that will rival the GSEs.
Yeah. And I mean, but in theory, yes, depository institutions could utilize blockchain technology for loans that they put on the balance sheet, but just more conservative, obviously, lender group, and the tech is still, just blockchain, and that world has been so up and down, and it freaks out bankers and credit unions, at least, from my perspective. But um so Michael, my guess is that IMBs, like, and your growth and all that. I mean, for IMBs, it's a pretty easy sell, right? Add HELOC to your product mix, happy customers, close in 5 days. How is your, with depository institutions, the traction that you've had with them? How's that been?
Honestly, it's been more challenged with credit unions and banks. We're starting to make traction there, but I think if you go, the persona of the IMB is a much more aggressive, right, entrepreneurial person and or business, where you got a lot of these mortgage entrepreneurs that started these companies, definitely enabled by Fannie Mae in many ways, and Freddie Mac, right, and the capital markets ecosystem they provide. Again, we want to do the same thing. So we appreciate that. But on the depository side, you don't necessarily have the same ambitious, I don't want to say that people aren't ambitious, because that's not really what I mean, but it's like the incentives and the way that people work is different, right? And it's not like you're totally trying to grow P&L. There's a lot more risk management. There's a lot more concern about counterparty risk. You kind of mentioned there's aversion to HELOC in general and second lien. So you don't have the same person that's saying, like, I'm ready to go. I just want, I see the opportunity, and I'm ready to go. It's much more longer sales cycle, more concerns. And I think now with Figure being profitable, Figure being a AAA originator, from a securitization standpoint, we're kind of past the point where a lot of the objections are going away, and we're starting to make traction, in that space.
Couple questions in the Q&A. One of them right along the lines of this topic that we're on right now. It says Chase's re-entry into home equity that was recently announced seems to follow a more traditional non-product offering such as Figure. Do you envision banks innovating to the more non-traditional structure as a result of this, or is this an opportunity for Figure to sell its lending as a service model to them?
Yeah, I think that Figure is not likely to be selling lending as a service to, large banks like a Chase,
Mhm.
just given, I think, especially Chase and really the big four banks, they invest a lot into technology. They are fierce competitors in sort of every area. So I don't think that they view themselves as needing a vendor like Figure, even though I disagree. I think they do. But my guess is that the way that they see the world is different. I think that Chase has done they definitely built a great brand, great mobile app, and there's a lot to like about Chase. But what I think that they're not going to do, because in many ways, necessity is the mother of invention, and they have a balance sheet that is essentially unlimited. They're not thinking about this broad standardized world that we are. And so I think over time you're going to have much more liquidity and standardization and modularization, with Figure. And so people that aren't Chase, aren't Bank of America, aren't Wells, and aren't Citi, which is the vast majority of mortgage, right? Those are going to be people that are going to adopt the Figure way. And I think the people that do are going to be competitive with Chase in the long run, right? So as an example, we have somebody like a Intuit Credit Karma as a partner, and they have a very attractive value proposition for people. And we're one of their flagship partners, and we are the flagship HELOC partner. And so, do you think that for somebody that's trying to manage their credit score that is a Chase customer, are they more interested in paying attention to what Credit Karma is saying, or are they paying more attention to the Chase app, right? And I think this goes back to my Affirm and and Klarna example of being an embedded finance company, we're saying let's partner with the best at customer acquisition and and focus there and let them use our process. Whereas, Chase is trying to be the best at everything, right? And I think that tons of IMB customers today are Chase customers, right? And they're not getting a mortgage from Chase because Chase doesn't have that sales and product culture that the IMBs have built. So we're sort of betting on people competing on the customer acquisition end versus saying we're going to go head to head with Chase on their customer, with their loan officer or their branch manager. So I do think it's a bit different.
And then the last question I have for you, Michael, any beliefs or predictions about home equity lending or real estate finance more broadly that you
Yeah, I think
think
you're going to
proven
see
out?
home equity. Oh, sorry.
Oh no, go ahead.
I
Yeah,
think you're
just
going
yeah.
to.
I was going to ask Michael, what is your long-term goal to have to rule the HELOC world? Every HELOC go through figure?
Yeah, I think we see HELOC as converging with first lien, right? And so we see HELOC and what the figure process is doing as more of a way to build an alternative, generally non-QM, in kind of you mentioned capital N versus little n. I would say like little n, meaning non-agency. We see figure as being a marketplace for embedded mortgage assets across basically everything the agency is not touching. That's what we're building for. And blockchain is making that faster and more efficient. We have a deep set of capital markets and a lot of buyers and a lot of sellers in that marketplace. And we see us providing standardization across a variety of products, not just a second lien HELOC.
So to that end, Michael, I mean, the fact that the GSEs are likely going to be led out of or attempted to be led out of conservatorship, unlikely we're going to see any changes major with them structurally, like, requiring MERS or those
Sure.
things. I mean, that's a competitive advantage for you then, no?
I think so. I think it depends on, I think we need to understand, and probably the agencies need to decide, what is their goal, right? Are they enabling middle-class home ownership? Are they enabling affordable housing? Are they profit-making entities in the mortgage space that are just seeking to grow market share and earnings per share, like, a for-profit company? And I think until we know, it's hard to say, exactly. But I do think that from our standpoint, they could be partners if they kind of open up and pursue more of that broader profit seeking way, because I think we have a really interesting approach that's much lower cost. And I think if they stick more in the affordable category, there's a lot we're doing to take costs out of the system. And I think, we could be partners there as well. And, I think or for the status quo, we can continue to innovate, where they aren't, and bring. The other thing is like the standardization of that the agencies have brought is not only unique in the mortgage space, it's unique in all consumer credit, right? Personal loan, auto, student, none of these small business, none of these categories have any sort of standardization across originators. Figure is really the first to do that. And I think we can, really think about the broad credit markets in terms of addressable market for that.
Good stuff. And a fascinating look inside a really fascinating company that's had some great growth these last few years, a really cool model, helping out just really legions of Americans kind of get access to cash and pay off credit in a quick and seamless way. And Michael, we really appreciate you coming on the show this afternoon with us. So
Yeah, thank you both for having me. Appreciate it.
good luck knocking off UWM. Voting still up
We'll
on my
do our
LinkedIn
best.
profile page. And a lot of people cheering for you. So,
Thank you,
uh,
sir. All
but
right, bye, guys.
all right. And to our viewers and listeners, thank you for joining us as always. We do this show live on Thursdays at 3 p.m. Eastern on Zoom if you're listening to the podcast or if you're watching on YouTube. So go to chrismancommentary.com if you want to get signed up for the live version of the show. So once again, thanks to Rob, thanks to Michael, and thanks to our
Thank you, Rich.
and
Thank you.
enjoy opening day. And we'll see you next Thursday at 3 Eastern, everyone. Have a great rest of the week and weekend. Take care.
Bye.